So now let us start with financial statements of companies. Okay. So now let us get into this topic called as financial statements of a company. Now, financial statements of companies. So for the companies, what set of financial statements they need to prepare and how they need to prepare, that's what is something called as a financial statements of the company. Here we need to discuss on basically about Schedule 3. We need to discuss about Schedule 3 and we should also discuss in brief about Schedule 5. So Schedule 3 and Schedule 5 has to be discussed. So what we are going to cover in this chapter? Three topics. Basically, this chapter we are going to cover three topics such as the most important from your examination point of view is managerial remuneration. How do I calculate the managerial remuneration? That's one thing. Then divisible profits. We need to discuss on something called as a divisible profits. How the company should declare a dividend out of its free profits. If the company does not have the profits for the current year, the company, after complying with few conditions, can declare the dividend out of the out of the previous year profits. Okay, first of all, you need to declare the dividend of the current year profits. If the current year you don't have any profits, you have a loss, then what are the conditions which the company has to follow so that it can declare the dividend out of the accumulated profits? That's what we are going to discuss as a part of the next one, divisible profits. That will be called as a divisible profits. Then finally we'll be discussing on something called as Schedule 3. There we'll discuss the format of the balance sheet as per Schedule 3. We'll discuss the format of the profit and loss account as per the revised Schedule 3. So these are the three parts which you are going to discuss. So basically today I'll be covering managerial remuneration and divisible profits. So in tomorrow's class and subsequent classes we can finish off the Schedule 3 aspects. Now regarding the managerial remuneration, calculation of managerial remuneration is very simple concept. Managerial remuneration, we need to focus on section 197 of Companies Act. We need to focus also on 198 of the Companies Act and few things of Schedule 5. Of course, we are, from your examination point of view, you are not going in depth into Schedule 5. I'll just give you the information which is required for us to calculate the managerial remuneration. That's it. Now, managerial remuneration. Basically, if we look into the Companies Act, the managerial remuneration, we can look at this provision from 2 point of views. One, managerial remuneration for a company. Okay, managerial remuneration for a company having profits. Managerial remuneration for a company does not have a profit. So here, managerial remuneration for the companies having profits. How do we calculate the managerial remuneration for a companies having profits? How do we compute managerial remuneration for the companies which do not having profits? These companies are not having any profits, not having profits or adequate profits. Okay, either these companies are not having profits or these companies are having inadequate profit. Inadequate profit, that means whatever profits which the company is having, that profits are not adequate to absorb the depreciation, then I can call that as inadequate profit. Either you are having loss or your profit is not able to cover the depreciation, so ultimately even there I will call that as an inadequate profit. Now, okay, first let us focus on the companies having profits. So the companies having profits, the section 197 clearly says the total remuneration, or you call that as a overall remuneration. You call either that as a total remuneration or you call that as a overall remuneration. That means, what is the meaning of overall remuneration? The total remuneration paid to all the directors in the company, whether he is a whole time, whether he is a managing director, or whether he is a manager, or any other director not being a whole time, any other director not being a managing director. So whoever are the directors, the total remuneration which you are going to pay to them should not exceed 11% of the profits. Okay, the total remuneration or overall remuneration payable to the directors should not exceed, should not be more than, not more than, should not be more than what? Should not be more than 11% of net profits. 11% of net profits. What is this net profits? This net profits as computed under section 198. This we'll discuss it later. First, let me finish off the provision. Then we'll get into section 198 and see how we can calculate the net profit as per section 198. Again, whoever directors the company have, the total remuneration paid to all of them should not be more than 11% of the net profits. Now, let us break up. Of these various categories of directors, how much remuneration I can pay to the each and every class of directors. Now let us see. Okay, in this, the standard says if you are having only one whole-time director, you are having only one whole-time director, or you are having only one managing director, or only one manager. Okay, only one person is there, only one whole-time director, only one managing director, or only one manager. The section 197 clearly states you that that section 197 clearly states you that the remuneration should not be more than 5% of net profits. When, if you are having only one director, if you are having only one whole-time, one managing director or a manager, then the remuneration paid to the whole-time director, one whole-time director, or one managing director, or one manager should not be more than 5% of the net profits. However, if your company have more than one whole-time director, or more than one managing director, or more than one manager, then the standard clearly says, then the section clearly says you what? The total remuneration should not be more than 10% of net profits. The total remuneration payable should not be more than 10% of the net profits. When you are having more than one whole-time director, more than one managing director, or more than one manager, that means what? You are having one whole-time director, you are having one manager, you are having one managing director, and you are having one whole-time director. In that case, the total remuneration payable should not be more than 10% of the net profits. Along with this, the standard also says one point, that you are having any director not a whole-time director, not a managing director. That means apart from the you are having a director who is not a whole-time director and not a managing director. In this case, what the section says? The section says that the remuneration payable in some cases could be 1%, in some cases that could be 3%. That's the reason 197 says the overall remuneration should not be more than 11%. How you are getting 11%? 10% plus 1%. 10% if you are having more than one director, 10%. Along with this, if you are having any whole-time director, any director who is not being a whole-time director, then it is going to be 1%. Then the total remuneration is going to be 11%. That's the reason the section clearly says it should not be more than 11%. Now, when it is 1%, when it is 3%, when there exists either a whole-time director, or there exists either a managing director. If the managing director or whole-time director exists, if there is a managing director, either whole-time director or managing director exists, then it is going to be 1% of your net profits. No whole-time director or managing director exists, then it is going to be 3% of the net profits. So that's what is the managerial remuneration which you are supposed to pay if you are having a net profit. If you don't have net profit or if you don't have adequate profit, then what? Then the managerial remuneration will be paid based upon something called as effective capital. We'll discuss what is the meaning of effective capital. We'll discuss at a later stage. Okay, once we finish off this provision, there we'll discuss the meaning of something called as our effective capital. So effective capital concept will be only applicable in the case of inadequate profits. If your capitals are adequate enough, then you need not calculate the effective capital. You will be calculating the net profit as per section 198. There 10% of that, 11% of that, 1%, 3%, 5% of that will be the managerial remuneration which is paid. Now, in the case of inadequate profit, I need to calculate effective capital. My effective capital could be negative, or my effective capital is less than. Effective capital is either negative or effective capital is less than 5 crores. Effective capital is negative or effective capital is less than 5 crores. Then the provision is different. That's what is the first thing. Second thing, we'll discuss. Under this case, what is the maximum possible remuneration? What is the limit of remuneration which is to be paid? Let us see. The next case is what? The next case is more than 5 crores. Your effective capital is more than 5 crores but less than 100 crores. More than 5 crores but less than 100 crores. Then the limit is different. The second thing is the remuneration, the effective capital is more than 100 crores. Okay, more than 100 crores but less than 250 crores. More than 100 crores but less than 250 crores. So these are the three different limits we are having. Here for the first limit, the maximum possible remuneration payable should not exceed, not exceeding 60 lakhs. The maximum remuneration payable should not exceed maximum 60 lakhs. If the effective capital is more than 5 crores but less than 100 crores, then the maximum remuneration payable should not exceed 84 lakhs. In the last case, the maximum possible remuneration should not be more than 120 lakhs. So this is nothing but the different limit which is purely based upon something called as the effective capital. Now, what is effective capital and how do we calculate the effective capital? Let us discuss. Then we'll move on to something called as section 198. Then we can discuss on the problems and how do we calculate your managerial remuneration. Now let us see. Effective capital. The next point is about how do we calculate the effective capital. So for this effective capital, we are referring to your schedule 5. In the schedule 5, section 2, we are going to refer. In that section 2, we are going to refer to something called as explanation 1. Okay, schedule 5, section 2, explanation 1 explains how do we calculate something called as effective capital. It's very simple concept. For calculation of your effective capital, what I need to do? I need to find out something called as aggregate paid up capital. Aggregate paid up capital. So you are having equity, you are having preference, add up everything. Which capital you need to have? Paid up capital. So take the aggregate of whatever capital you have, that I need to take. The total I need to consider. Total equity paid up capital, total preference paid up capital, whatever it is there, that aggregate I need to consider. Then if you are having something called as what? Share application money. If you are having something called as share application money, or you may call that as what? Or anything called as advance against the shares. So exclude. I need to exclude share application, any sort of share application money, or anything advanced against shares. Advanced against shares. If that is included, that I need to exclude. If your paid up capital includes this, I need to exclude that. Then what I need to do? We should add up. What I should add? Any sort of reserves and surplus. Whatever reserves and surplus you have, all the reserves and surplus I will add. But okay, I will be taking my reserves and surplus. If this reserves and surplus includes any sort of revaluation reserve, if this reserve and surplus includes any sort of revaluation reserve, that revaluation reserve I should exclude. So reserves and surplus should be considered excluding of your revaluation reserve. That we need to consider. Then apart from this, we should also add what? Add any sort of long-term loans, any sort of long-term loans and deposit. See, what is the meaning of long-term loans and deposit? Repayable after a period of 1 year. Repayable after a period of 1 year. You should not consider working capital. You should not consider overdrafts. You should not consider interest on loans unless funded by bank guarantee. Unless funded. Only if these are funded things can be considered. Okay, these are the things which you need to consider. So add up everything. You need to add up everything. From this, what I need to do? I need to reduce any sort of investments made. Reduce investments. I need to reduce aggregate of investments. Investment aggregate. Whatever investments you are doing, aggregate that. So this investments made has to be reduced. This investments made has to be reduced. But if this is an investment company, then no need to reduce what? Investments. For other companies other than investment, I need to reduce. So apart from this, any sort of accumulated losses, preliminary expenses has to be written off. So what I will do, if you are having any sort of accumulated losses, preliminary expenses written off, all these things also has to be reduced. So once you do this, you will be getting something called as what? You will be getting your you'll be getting something called as your effective capital. So this will give you something called as your effective capital. So depending upon the effective capital, if your effective capital is negative or less than 5 crores, the managerial remuneration is going to be 60 lakhs. If it is more than 5 crores but less than 100 crores, it is going to be 84 lakhs. More than 100 but less than 250 crores, 120 lakhs. So depending upon that, when this will be calculated, if no profit or inadequate profit, then you will be calculating your effective capital base. If you are having an adequate capital, then I need to calculate the profit as per section 198. Now let us move on to section 198. Now, ascertainment of profits as per ascertainment of profit as per section 198. Ascertainment of profit as per section 198. So how do we calculate? Say the Companies Act section 198 clearly says that few credits has to be considered, few debits has to be considered, few credits should not be considered, few debits should not be considered. So now let us see, in computation of your profits, if you are getting any sort of subsidies, if you are getting any sort of grants from whom? Grants from government. So if you are getting any sorts of grants from government or any sort of public authority, generally what will happen? This will be credited to the profit and loss account. So this will be credited to the profit and loss account, which is allowed. You can consider that as a credit. That means if your profit and loss account consists of your subsidies and grants which are from the government, those things will be considered as your income. That things can be added. Then, okay, then the point says this credit can be considered. The next point says credit. These following credits should not be considered. You should not consider this credit, should not be considered. That means if these are credited to the profit and loss account, you should not consider this when you are calculating your net profit. So credit should not be considered. What credit should not be considered? Let us see. The first point says profits by way of premium on shares or debentures of the company which are issued or sold. Whatever premium received on issue of shares or debentures, if this premium received by way of issue of shares or debentures is credited to your profit and loss account, that should not be considered for calculation of your net profit. That should. So whatever premium received on issue of shares or debentures, if that is credited to the profit and loss account, that should not be considered for calculation of your net profit as per section 198. Then the next point says you are getting some sort of profit on share forfeiture. You had forfeited some shares. On that you are getting some sort of profit. So it's a capital profit. Whatever capital profit which you are getting, if you are crediting that to your profit and loss account, that should not be considered as per section 198. Then, okay, the next point says profit on sale of undertaking. Profit on sale of undertaking. Okay, profit on sale of an undertaking. You are having an undertaking, you are selling that undertaking. Profit on sale of undertakings or undertakings or part thereof. You are selling the entire undertaking, or you are selling a group of undertaking, or you are selling a part of the undertaking. If you are having any profit on sale of undertaking or sale of undertakings, okay, you are having 4 undertakings. What you are doing, you are selling one undertaking, or of the 4 you are selling 2 undertakings. So ultimately in the group company, what you will do, you will be creating the profit on sale of undertaking or undertakings or part. This is not allowed for calculation of a profit as per section 198. Then this point is very important. This fourth point is very important. What this point says, this point clearly says, first let me write what section 188 says, then I will explain this point with an example. Okay, profits, okay, from what? From sale of immovable property. Profits from sale of immovable property. Whatever profits you are getting from sale of immovable property, what it says, immovable property, or it could be called as your fixed assets, whatever name you are calling. Okay, unless, okay, here what the point says, profits from sale of immovable property or fixed assets which is a capital nature, compressed in undertaking. That means these fixed assets are used in undertaking, compressed in undertaking or undertakings. Unless the business, see, this point is not applicable for an undertaking. So profits from sale of an immovable property or fixed assets compressed in undertaking. This point is not applicable if your business is buying the fixed assets and selling the fixed asset. Say for example, real estate dealer is there. Your business is real estate. For a real estate, the business is what? Buying the land and selling the land. In that case, if you are selling the land, then ultimately this point is not applicable. So this is not applicable if business is acquiring or disposal of fixed assets. So if your business is that, this point is not applicable. So this point is applicable for remaining all undertakings whose business is not. Why? Because if your business is acquisition and disposal, for you I cannot call this as a fixed asset, I'll be calling this as a stock in trade. So this is applicable only in the case of a fixed asset. That's it. Now what the point says here that profit should not be credited, but here there is one interesting thing which we need to consider. So what it says, provided that, the section says provided that, let me write the section so that I will explain clearly. provided that what it says, where amount for which any fixed asset sold is sold. Okay, you are selling the fixed asset. Okay, you are getting some sort of sale consideration. So here this point is speaking about the sale consideration is sold exceeds WDV. See, when I will call that as a profit, when the sale consideration exceeds your WDV, then only I can call that as a profit. Okay, now exceeds the WDV. Okay, when it is exceeding the WDV, what the statement says here? Credit can be given. So credit should be given. Credit, I can give the credit. Credit should be given for what? Credit should be given for can be given for as much. Okay, credit can be given for what? As much, so much of what? So much of excess. So much of excess as is not higher. Okay, so much of excess as is not higher of what? Is not higher than difference. Okay, so much is not higher than the difference between what? Difference between original cost and its WDV. That means what you can do, you can consider a credit only to the extent of original cost and WDV. Let me explain this. Say suppose original cost of the asset 10 lakhs. Original cost of the asset is 10 lakhs. You have used the asset for 2 years. Let me consider the depreciation is 10% on WDV. First year you have taken a depreciation of 1 lakh. The WDV at the end of year 1 is 9 lakhs. Second year also you have taken a depreciation of 10%. The WDV at the end of second year is going to be 8,10,000. Right? So this is nothing but the WDV at the end of second year. Imagine at this year, end of second year, the asset was sold. For a sale consideration, let us consider 12 lakhs is the sale consideration. 12 lakhs you assume that to be called as the sale consideration, right? Now, here, what is the profit? What is the surplus? When you calculate the profit or loss, what I will do? I will consider the sale consideration 12 lakhs minus my written down value. What is the written down value? The written down value is 8,10,000. So what is the surplus there? 12 lakhs minus 8,10,000 will give you what? 90. If I add 90, 3 lakhs 90,000 is nothing but the profit. That's what he's telling. So here what he's telling, provided that amount for which the asset is sold, sale consideration, exceeds WDV. So your sale consideration exceeds WDV by 3,90,000. That's what is the meaning for this. So there is a surplus of 3,90,000. There is a profit of 3,90,000. I cannot consider this entire 3,90,000. What he says, I can consider as much as is what? The difference between original cost and WDV. So now if I consider original cost is what? 10 lakhs. WDV is what? The WDV is nothing but 8,10,000. So the section clearly tells you that you can consider the difference of 10 lakhs and 8,10,000, which will give you what? Which will give you how much you are getting there? 1,90,000. What is this 1,90,000? The depreciation claimed so far. You had claimed a depreciation of 1 lakh in the first year, 90,000 the second year. So ultimately total depreciation claimed by you is what? 1,90,000. So the 198 clearly says that you can take this depreciation. That means you can show a profit to the extent of 1,90,000. Why? The reason is simple. Till now, you had been claiming this 1,90,000 as your depreciation. First year you have debited 1,90,000 as your depreciation. Second year you have debited 90,000 as a depreciation. So 1,90,000 already you had claimed that as a depreciation. Your profits was understated to the extent of 1,90,000. Now you got a profit of 3,90,000. Of this 3,90,000, 1,90,000 you had debited, you had reduced your profits earlier. Now what the standard says, as you got a what the section says, as you got a profit of 3,90,000, as already you claimed a depreciation of 1,90,000, you can reverse this. You can consider now this as your income. So this can be credited to your profit and loss account. The remaining 2 lakhs cannot be taken as a credit in your profit and loss account. That's what. Again, if you read this statement now, that will be very clear for you. Amount for which this fixed asset is sold exceeds the WDV. Fixed asset is sold for 12 lakhs, WDV is 8 lakhs, it is exceeding by 3,90,000. This is what is something called as excess. Credit should be given not high than, okay, credit should be given for as much as of such excess. That means as much of such excess is 3,90,000, and what it says, not exceeding the difference between original cost and WDV. Original cost was 10 lakhs and WDV is 8,10,000. The difference is nothing but the depreciation you are claiming. So whatever surplus you get, only the amount which you had taken as a depreciation earlier can be considered as a credit. Remaining things should not be taken as a credit. So that's what is this point makes this very important. Then the last point in your credit. So if we credit what we have discussed premium on issue of shares or debentures should not be considered. Any sort of share forfeiture profit should not be considered. Any profit on sale of undertaking or undertakings or part thereof should not be considered. And profit on sale of immovable property you can consider to the extent of depreciation claimed earlier. So in nutshell, what you can consider? Credit of depreciation allowed so far can be considered, not the entire surplus. Now, the last point here. The last point says you are having any change in amount of asset. Okay, there is something called as carrying amount of asset. Change in carrying amount of asset compared with the fair market value. Carrying amount of asset was 9 lakhs. Fair market value of the asset is increasing to 10 lakhs. So ultimately, there is an increase in the fair market value of the asset. Or it also says any sort of change not only in the asset, it also says that any sort of change you are having in liability which is recognized in equity. Any sort of change in liability which is recognized in equity, if the carrying amount of that is changing in terms of your fair market value. Carrying amount of the asset, carrying amount of the liability is changing as compared with the fair market value, then ultimately I should not credit this. So these are the following credits which should not be considered. Now let us see debits should be considered. What sort of debit should be considered? See, if you summarize, go to the first point. What the point says, any sort of subsidies or grants is for the government should be considered. And premium on issue of shares, forfeiture, profit on sale of undertaking, profit on sale of any sort of fixed asset or immovable property, you can consider only to the extent of depreciation allowed. Beyond that you should not consider. Then now you are considering, and also any sort of changes happening for the carrying amount with the fair market value should not be considered. Now what sort of debit should be considered? Let us see. The following debit should be considered. What sort of things? Any sort of working charges. To run the company you are incurring some sort of working charges, that can be considered. You can consider the director's remuneration can be considered. You can also consider whatever bonus or any commission, whatever commission you are going to pay to any member or technician, okay, whether he is a whole time or on part time basis, any sort of bonus or commission paid to the staff can be considered. And you can also consider any tax notified by the government in nature of taxes on excess or abnormal profit. So you can consider tax notified, okay, tax notified by central government in nature of a tax, on excess or abnormal profit, not on your regular profits. Whatever abnormal profits you are getting, on that abnormal profits, if you are having any sort of tax which is notified by the central government, that you can consider, not the entire tax. So that can be allowed as deduction. You are paying some sort of interest on debentures, that interest on debentures can be allowed as deduction, that can be deducted. Interest on mortgages, interest on mortgages, there is some sort of mortgage executed by the company, and on the mortgage you are paying some sort of interest, that interest on mortgage can be deducted. You are also having some sort of interest on unsecured loans or and advances. So any sort of interest on unsecured loans and advances also can be deducted. You are incurring some sort of expenses on repairs, and the repairs are of revenue nature but not the capital nature. If the repairs are of the revenue nature, you cannot consider. The repairs could be for immobile property or the mobile property, but the repairs should be exclusively of the revenue in nature. Okay. Then any sort of outgoings as specified under section 181, as specified under section 181, that outgoing should be considered. Then you can consider the depreciation, not the entire depreciation. Depreciation specified under section 123 of the Companies Act. Okay, that can be considered. Then the next point is most important. You can consider excess. Excess of what? Excess of expenditure over income. What is the meaning of excess of expenditure over income? Which is something called as loss. You can consider the loss. When loss which had arisen in previous years after commencement of the act. So you can consider excess of expenditure over income loss during the previous year preceding the year in which net profits has to be ascertained. So your current year, say for example for the financial year 2021, you are trying to calculate whatever losses you are getting before that, that can be adjusted here. If that remains unadjusted, so far as such excess has not been deducted, okay, in any previous year preceding to the year in which net profit have to be ascertained, in the year in which you have to ascertain your net profit have to be ascertained in that period, for that period you can adjust. If that has not been adjusted earlier, if that is already adjusted, then you don't have any sort of your previous accumulated losses. Accumulated losses should be adjusted in that year in which you want to calculate your net profit. That's what is one important thing. And it also says any sort of compensation or any sort of damages or any sort of legal liability arising from breach of contract. Compensation or damages or legal liability arising from breach of contract. You have done some sort of breach. For that breach you have paid some sort of compensation. That compensation could be considered. Then any insurance, any sum paid towards insurance premium against any sort of risk of meeting the above liability. So you know that there may be some sort of legal consequences arises. You may know that you may be having some sort of damage or compensation. For that you are taking some sort of insurance premium. So whatever insurance premium paid for meeting the risk of the above, even that can be considered. Then any sort of debts considered as bad, any sort of debts considered bad can be considered. So these are the following debits which are allowed. Now what are the debits which are not allowed? Debits not allowed. So what are the sort of debits which are not allowed? Let us see. Any sort of income tax, okay, or tax on any other income. So whatever income tax you are having, if that income tax or provision for income tax is debited to the profit and loss account, those sort of debits are not allowable. Then the next thing says, any sort of compensation or any sort of damages made voluntarily. You are making the compensation, you are paying the damage voluntary. This is not arising by way of a legal. If it is arise by way of a legal, then that is allowed. If you are paying that voluntarily, then you cannot take this as a debit. Now, you are having some sort of capital loss on sale of undertaking. Same point here. Any sort of profit you are obtaining on sale of undertaking or undertakings, as how you are not considering. If you are getting a loss on sale of undertaking or undertakings, you should not consider that. Okay, the same thing. Now, okay, any sort of capital loss on sale of undertaking or undertakings or part thereof in excess of the WDV should not be considered. Or its sale proceeds should not be considered. So you are having a difference of your WDV and you are having a sale proceeds. This difference, if this result in loss, this difference should not be considered there. That's it. Now, same point here, any change in carrying amount of asset or liability or any sort of liability which is recognized in your equity reserves as compared with the fair market value should not be considered. Same point we have discussed when you are calculating your credits, the same point we are discussing when you are calculating your debits. So that's what is the things which you need to remember for calculation of something called as your managerial remuneration. Now we are all set to do the problems on managerial remuneration. So let us quickly compute the problems there so that we can move on to something called as what divisible profits. I think you are having 3 problems. So let us try to wind up this 3 problems now. Okay, now let us get into the problem here. The following is a draft balance sheet of Mudra Limited for the year ended 31st March. Administrating, selling expenses, distribution expenses, so everything is given. Directors fees is given as 1,34,780. Interest on debentures, managerial remuneration is given as 2,85,350. So directors fees is given, managerial remuneration is given as 2,85,350. Depreciation on fixed assets is given, provision for taxation is given, general reserve is given, investment revaluation reserve is given, balance carried down, balance brought down, balance from trading account, subsidies. So now, what is asking? Depreciation on fixed assets as per Schedule 2 of the Companies Act was 5,75,345. Okay, that's what is the depreciation allowable as per the Companies Act. You are required to calculate the maximum limits of managerial remuneration as per the Companies Act. Company having a profit. As the company having a profit, the overall remuneration will be 11% of the profits. So here, but I need to calculate the net profit as per section 198. When we calculate the net profit as per section 198, anyways your trading receipts will be considered, and we have also considered the credits to be considered. Any sort of subsidies or grants received from the government should be considered. So I'll be considering what? 40,25,365 plus 2,73,925. This total is nothing but 42,99,290. I will consider this as my total credit. I won't consider this balance brought down or whatever it is. I'll be considering only 42,99,290. Then what I need to deduct? The standard clearly says you that you can deduct your working charges, any expenses which is nothing but your operating expenses. It also says any sort of fees paid to the directors can also be considered. Interest on debentures can also be considered. You are calculating this for what? For the calculation of your managerial remuneration you are calculating. So don't consider the managerial remuneration. Depreciation I can consider, but not this. Depreciation as per the Act. The Act says 5,75,345. So I need to consider Depreciation of 5,75,375. Taxation I should not consider. Reserves I should not consider. Investment reserves I should not consider. So from this credits, if I consider the debit of what? Less administration expenses, 8,22,542. You consider this as A. Okay. Then interest on debentures. Interest on debentures. What is the interest on debentures? 31,240 is the interest on debentures that we are considering. And we'll also consider the director's fees, which is nothing but 1,34,780. What is this? Director's fees. We'll be considering the director's fees. That will be considered. Then depreciation. Depreciation as per section 123 or schedule 2. What is the depreciation as per schedule 2? 5,75,345. So I'll be considering this. Do the total of this. The total expenses, the total debits is what? 8,22,542 plus 31,240, 1,34,780, 5,75,345. So this total is coming to 15,63,907. 15,63,907 is the total. So this is nothing but your total debits. Call this as B. Now A minus B is something called as net profit under net profit as per section 198. So 42,92,290 minus 15,63,907 will give you 27,35,383. So what is the net profit here? 27,35,383 is your net profit. So now what section 197 says? The overall remuneration should not be more than 11% of 35,383 into 11%, which gives you something called as 3,02,892. So the managerial remuneration should be 3,0892. Okay, 3,0892. The maximum possible managerial remuneration can be 3,0892. That means what? You can pay the remuneration less than this, but you cannot pay the remuneration more than this. In the present problem, what was the managerial remuneration? The managerial remuneration debited to the profit and loss account is 2,85,350. You can pay less than this, but you cannot pay more than this. So in this case, you can pay managerial remuneration of 2,85,350. That's what is nothing but your problem number 1. Now, let us quickly move on to the second problem. Second problem, which is purely again based upon calculation of your managerial remuneration. Let us see what this problem is about here. Balance sheet is given. Authorized capital, issued and subscribed capital, 15,000, 14% preference shares of rupees 100 each, fully paid up. So paid up capital is 15. 1,20,000 equity shares of rupees 100 each, 80 paid up. So the paid up capital is 96 lakhs. Now you are also having share suspense account 20 lakhs. Capital reserve 1,95,000, which includes 1,50,000 revaluation reserve. That means from 1,95,000, if I remove the revaluation reserve, I'll be having only 40,000. Okay, securities frame you are having 50,000. 15% debentures 65 lakhs. Unsecured loans, public deposit 3,70,000. Cash credit short term from the State Bank of India 4,65,000. Current liabilities you are having trade payables 3,45,000. Investment in shares and debentures 75 lakhs. Profit and loss account debit balance 15,25,000. What is the meaning of this? You are getting losses. Whenever you are getting losses, whenever the profits are not adequate, we need to calculate the managerial remuneration based upon effective capital. So in this case, effective capital should be calculated. Share suspense account represent application money received on shares for which the allotment is not made. Application money received in advance for which allotment is not made should not be considered. Now, if we go back and discuss on how do we calculate our effective capital, what we have discussed, aggregate paid up capital. What is the meaning of aggregate paid up capital? Preference plus equity. What is the aggregate? 15 lakhs plus 96 lakhs is something called as the aggregate. So I need to consider 15 plus 96. Let us see how much you are getting. 15 plus 96. let us see, 15 lakhs plus 96 lakhs, the aggregate you are getting is 111. So you are getting what? 1 crore 11 lakhs is nothing but the aggregate. So aggregate of your paid up capital is nothing but 1 crore 11 lakhs is nothing but the aggregate of the paid up capital which you are getting. Now we have taken the aggregate. Then what? So once we take the aggregate, what I have to consider, the next one is nothing but your reserves and surplus. Reserves and surplus. What is the reserves and surplus? The reserves and surplus, here you are having two things. One, you are having your cap reserve. One point we have discussed. You can take over all the reserves and surplus, but the reserves and surplus should not be considered of. The reserves and surplus should not be considered of your revaluation reserve. The revaluation reserve is what? 1 lakh 50. 1 lakh 95,000 minus 1 lakh 50, you will be getting 45. So capital reserve I can consider only 45,000 as my cap reserve. Securities premium I can consider the extent of 50,000 will be considered as my security premium. Then what we have discussed, long term liabilities more than 1 year. So anything which is called as for long term liabilities is nothing but your 15% debentures, 65 lakhs will be considered. Then what? Public deposit. Even this public deposit, even that is unsecured, more than 1 year. So I will be also considering my public deposit will also be considered. What is the amount of public deposit? 3,75,000. Then cash credit you should not consider, overdraft you should not consider because it's short term. So short term liability should not be considered. Now what we are supposed to do? We need to add up. We need to add up everything. 1 crore 11 lakhs plus 45,000 plus 50,000 plus 65 lakhs plus 3 lakhs 75,000 will result in 1 crore will result in 1 crore 80 lakhs 65,000. 1 crore 80 lakhs 65,000 is the total which you are getting. From this I need to reduce what? Any sort of investments, any sort of accumulated losses, any sort of preliminary expenses written off has to be reduced. In this case, my investment is 75 lakhs. My investment is 75 lakhs. I will reduce 75 lakhs. My accumulated losses is going to be 15 lakhs 25,000. I will reduce 15 lakhs 25,000 also. What is this total you are getting? Let us call this total as A. Let us call this total as B. So 75 lakhs plus 15 lakhs 25,000. The total gives me 90 lakhs 25,000. So you are getting this as what? 19 lakhs 25,000. Now the different, what is your effective capital? Effective capital is something called as A minus B. What is A? 80 lakhs, 1 crore 80 lakhs 65,000. What is B? 90 lakhs 25,000. 1 crore 80 65 minus this gives you effective capital as 90 lakhs 40,000. 90 lakhs 40,000. Now what is the remuneration which we need to consider? Let us see. The remuneration here, depending upon your effective capital base, if I try to see this here, okay, fine, we have discussed this somewhere. Okay, fine. So what we'll do here, whenever you are having this particular calculation of your effective capital base, what we'll do here, depending upon your effective capital, if your effective capital is negative, if your effective capital is negative, then depending upon the negative, okay, let us come back here, right? So if you are having an effective capital negative to 5 crores, the remuneration is going to be 60 lakhs. 5 crores to 100 crores, the remuneration is going to be 84 lakhs. 100 to 250 crores, the remuneration is going to be 120 lakhs. So here it is less than 5 crores. So as effective capital is less than 5 crores, the remuneration is going to be what? 60 lakhs is the remuneration which you are supposed to consider. So the remuneration is going to be 60 lakhs is the remuneration. So that's it. So remuneration payable. So here what is asking? Remuneration payable is going to be 60 lakhs, which is purely depend upon your effective capital base. Now Will your answer be different if your X Limited is an investment company? Obviously, if X Limited is an investment company, I need not reduce investments. I'll be reducing only my accumulated losses. If I reduce my accumulated losses, that means what? 1 crore 80 lakh 65,000 minus 15 lakh 25,000, that will give your effective capital. So your effective capital is changing. So your effective capital there will change. But your effective capital will not change beyond 5 crores. It will not go beyond 5 crores. As it is not going beyond 5 crores, ultimately what will happen? As it is not going beyond 5 crores, the remuneration will be fixed as 6 lakhs only, 60 lakhs only. That's it. So even though the company is investment company, only the difference will be in the investment, as this total is not beyond 5 crores. So ultimately that the remuneration payable will not change from the first situation to the second situation. That's it. Problem number 3. Kumar Limited, a non-investment company, has incurred losses for the past few years. He has given you the paid up. So what I need to do, I want you to solve this problem. You need to prepare your what? You need to calculate your capital. You need to calculate your effective capital. How do you calculate your effective capital? Aggregate paid up. So what is the aggregate paid up? 140 is nothing but the aggregate paid up. You can take your reserves, but you should not consider your revaluation reserve. So what I will do, I'll be minusing this 10 and I'll be considering this as 140, and I can consider my securities premium 40. So if I do the total here, how much you are getting? My aggregate capital is 140. My reserves is what? 140 plus 40. My reserves I can consider it as 140 plus 40. My reserves I can consider it as 180. So I am having a reserves of 180. And long-term loans you are having, I can consider my long-term loans as 20. Deposits returnable after 1 year, I will consider it as a 20. We won't be considering the share application money pending against allotment. So accumulated losses will reduce this, investment will reduce this. What is this total you are getting? Let us see the total. 140 plus, if I add this 20 here, 200. 200 plus 140, you will be getting 340. Okay. 340 plus 40 will be getting 380. So the total will be what? 380 will be the total. So this total is going to be 380. Then from this 380, what I will do? I will reduce my investments amounting to 180. And I will also reduce my accumulated losses amounting to 220. So 380 minus 180 will give you 200. 200 minus 20 will give you 180. So your effective capital is 180 lakhs. Effective capital is 180 lakhs. So ultimately less than 5 crores. As your effective capital is less than 5 crores, the remuneration is what? The remuneration is going to be 60 lakhs. So the remuneration, maximum remuneration payable to Mr. Kumar will be going to be 60 lakhs. Okay. And one more point I want to mention here. The standard clearly says the 197 clearly says the overall remuneration cannot be more than 11%. Individual remuneration payable, if only one person is there, 5%. If there are more than one whole-time directors, managing directors, or manager, then the total remuneration cannot be more than 10%. And if you have any person other than whole-time director, managing director, or then ultimately 1% or 3%. If you want to pay more than this limit of 11%, 5%, 10%, and 3%, what you need to do? You need to conduct a general meeting, and you should also take an approval of central government. With that, you can always go and you can pay them more than 5, 10, 1, 3, and the overall percentage of 11. So to pay more than this limit as specified, approval of government is required. General meeting has to be conducted. Without that, you cannot do this. Okay. So with this, I can say the managerial remuneration part is done. Now let us quickly go on to the other topic called as divisible profits. For this, we need to refer section 123 subsection 1 of the Companies Act. What it says? Section 123 of the Companies Act says dividend should be declared. Dividend should be paid. Okay, you can pay the dividend only out of, you can pay the dividend only out of the three. Only out of what? Let us see. Only out of 1, profits of profits for that financial year, profits for that financial year after providing depreciation, after providing depreciation in accordance with the section. So whatever profits you get, you provide depreciation, then whatever profits which is remaining after depreciation, that can be used for making declaration of your dividend. Then current year you don't have profits, in that case you can declare the out of profits of previous years after providing current year depreciation. So you can take the last year profits. From the last year profits you can declare, but from the last year profit first you reduce your depreciation, whatever balance you are having with that you can pay. Or in some cases out of both A and B, even I can pay with both A and B. And the last one says with money provided by the central government or money provided by the state government for payment of dividend. If central government or state government is giving you some sort of money for payment of dividend, then you can do. Okay, so this is in terms of guarantee given by the government. So these are the only three cases where you can declare dividend. So if you are having a profit, then only you can declare dividend. Current year don't have profit, and not only that, current year you have a profit, and that profit should be after providing depreciation. So after allowing depreciation, if you still have a profit after providing depreciation, if you still have a profit, then you can take the then only you can take the then only you can declare the dividend. Otherwise you cannot declare the dividend. So you are having a profit where the profit is after providing depreciation. Current year you don't have profit, last year you are having some profit, that last year profit you can consider after what, after taking the current year depreciation you can take that. Okay, so you don't have the current year profits, you are having a bought forward profits. From that you provide for the current year depreciation, whatever profits is there that can be used, either A plus B can be used. So that these are the three cases. Now it also says one important thing we need to understand, that declaration of dividend when there is an inadequacy of the profits, then out of the reserves and surplus, dividend can be declared out of accumulated profits in case of inadequacy of profits during the current year. This is done after complying the following conditions. After complying the following conditions, what you can do, you can declare the dividend out of the accumulated profits also, not the current year profits. From the previous year bought forward profits you can declare the dividend if the following conditions are satisfied. There is nothing but as per company's dividend declaration rules 2014. Now what the rule says, your rate of dividend, whatever rate of dividend you are declaring, that rate of dividend should not exceed the average rate of average rate at which dividend was declared in 3 years dividend was declared in 3 years immediately preceding to that year. Say current year you don't have profits, you want to declare the dividend out of your brought forward profits or accumulated profits, then what the provision says here, out of accumulated profits you can declare the dividend, but you need to comply the conditions. You cannot declare a dividend at a rate which is more than 3 years average. So 3 years average I need to consider. Say before last year I got a profit and I had declared the rate of dividend of 12%. Last year I got a profit of 10%, I declared a dividend of 10%. Then I had declared dividend of say, let me consider what, 22, 14%. Now what is the total you are getting? The total is what? 22 plus 14, that gives you 36. 36 by 3, average rate is what? 12%. You are getting an average rate of 12%. So current year you can declare dividend, but your rate of dividend should not be more than 12%, should be less than 12%. That's what is the first condition. Then second condition, let us see what is the second condition. Second condition says, this is very important. The second condition says total amount to be drawn from the accumulated profits should not exceed 1/10 of the paid up capital and free reserves. Okay, what it says? Maximum amount to be drawn, maximum amount to be drawn is what? Is paid up capital plus free reserves. Take your paid up capital plus free reserves. Of that, take what? 1/10. So of that, take 1/10. 1/10. So that is the maximum amount which you can draw. Say suppose your paid up capital of the company is 10 lakhs. Paid up capital of the company is 10 lakhs. And you are having a free reserves to the extent of 2 lakhs. Then what is the total amount you are having? 12 lakhs is the total amount you are having. Now what is the maximum amount you can draw? 1/10 of this. That means 1/10 of this is nothing but the maximum amount you can draw is nothing but 1,20,000. So the maximum amount to be drawn in this case is nothing but 1,20,000. So first condition is what? You can pay the dividend, but the rate of dividend shall not be more than the average of past 3 years. Then the second point is what? You can draw the amount, but your amount draw should not be more than 1/10 of the total paid up capital plus free reserves. Then the next point says, after drawing this amount of 1,20,000 here, what you can do? The first thing is what? Amount drawn, whatever amount drawn should be used for what? Amount drawn should be used for set off loss. So whatever loss you get in the current year, you set off that loss first. Okay, set off loss incurred in which dividend is declared. So set off of the loss before declaring dividend, set off the loss of the year in which you are going to declare the dividend. So first you need to set off. When you need to first use for set off the loss before declaring dividend. So before declaring dividend, you should set off the loss first. That's what is the other condition you need to comply. Then the other most important condition is what? The other most important condition is balance of reserve. Balance of reserve after such withdrawal. After such withdrawal, you are withdrawing some amount. You are withdrawing 1,20,000 amount. So balance of reserve after such withdrawal, shall not be below what? Below of 15% of your paid up capital. Shall not fall below 15% of your paid up capital. Means what? Means the other condition says what? Take 15% of paid up capital. Take 15% of paid up capital. Okay, and you compare this 15% of capital with reserves and surplus minus reserve withdrawn. You compare. Now what the condition says, your reserves and surplus should not fall below. That means what? Here the statement clearly says reserves and surplus minus what? Reserves and surplus minus withdrawn. This should be always greater than 15%. Now 15% of your paid up capital. In the present example, what is 15% of your paid up capital? 1,50,000 is 15% of your paid up capital. How much amount you had withdrawn? 1/10, 1,20,000. Now this 1,15% is nothing but your 15% of your paid up capital. Reserves and surplus as per the latest audited balance sheet was 2 lakhs. Amount withdrawn was 1,20,000. So what is the balance available? 80,000 is the balance available. Condition not satisfied. So in this case, you can't withdraw 1,20,000. You can withdraw to the extent of what? My balance should be 1,50,000. That means I can withdraw only 50,000 from my reserves. If I withdraw 15,000 or I can withdraw 49,000. If I withdraw 49,000, what will happen? 2 lakhs minus 49,000. My reserve balances will be 1,51,000. 1,51,000 is more than 1 lakh. Right. So now the last condition is what? Dividend is not to be paid. Dividend is not to be paid unless bought forward loss or depreciation, whichever is less is provided. So without providing for the bought forward loss or without providing for the depreciation of the current year, at least you need to provide whichever is least. Then whatever balance is available, with that amount only you should pay the dividend. Otherwise you are not entitled to pay any sort of dividend. That's it. So with this background, we are ready to do the problems there. So now let us start working with the problems. I think you are having two problems. I think one problem is there. Yeah, let me check. Yeah, you are having one problem. So let us try to close this problem so that divisible profits will be done. So that in next class, what we can do, we can discuss on something called as dividend distribution tax. There is an amendment in the dividend distribution tax. Okay, I will discuss that tomorrow. What is the amendment which is applicable for your November as well as December examination? I will tell that tomorrow. So once that is done, tomorrow I will be focusing on your schedule 3. So I will discuss the complete coverage of schedule 3. We'll quickly run through the schedule 3, which is given by MCA, Ministry of Companies Affairs. We'll discuss that. Then we'll start working with the problem. So we'll do 3 or 4 problems in your company final accounts. We'll discuss the standard. We'll discuss schedule 3 tomorrow. So maybe in the tomorrow's class we can finish off 1 or 2 problems. So the balance of problems will be finishing off in the other class. Maybe in another 2 classes I will try to close the company financial statements. I mean financial statements of a companies. Now let us quickly get into this problem so that the topic. So right now let us look into this problem. Due to the inadequacy of profit during the year end 31st March, X Limited proposed to declare 10% as a dividend out of general reserve. Out of accumulated profits, the company want to declare dividend. It can do, but the above mentioned conditions ought to be satisfied. From the following particulars, ascertain the amount that can be utilized from general reserves in accordance with the company's declaration of dividend rules 2014. So what the rule says here? You can draw the maximum amount of 1/10 of your paid up capital plus free reserves. What is the paid up capital plus free reserves? Let us see. Here, the paid up capital is 17,50,000 plus 80 lakhs. So, the total paid up capital here is nothing but this. Okay. Then, yeah. What are the free reserves you are having here? The free reserves you are having is nothing but general reserve is the free reserves you are having. So ultimately here I cannot use the cap reserve. The free reserves, the general reserves is nothing but your this. So ultimately if I apply this condition, what? Paid up capital preference shares 17,50,000 plus 80 lakhs. This gives you your aggregate paid up capital plus available free reserves. You are getting 25 lakhs. Of this, what is the standard? The particular section says 1/10 you can draw. So 1/10 of this is coming to 12 lakhs 25,000. So 1/10 of this comes to 12 lakhs 25,000. That's one thing. Then what he says, after withdrawal, your balance of reserves should not fall. After the withdrawal, your balance of reserves should not fall below what? Below 15% of your paid up capital. Now 15% of my paid up capital. What is my paid up capital? My paid up capital is 97 lakhs 50,000. Then what is 15% of this? 15% of my paid up capital is nothing but 14 lakhs 62,500. Now if I withdraw this amount, okay, what is the balance of reserve you are having? the balance of reserve, that means your reserves minus the withdrawal amount, should not be less than, should be always more than 14,62,500. Now let us see what is the other information given. Revaluation reserve is given as this. Profit for the year ended is given as 3 lakhs. 3 lakhs. So for the current year, you are having a profit. You are not withdrawing the entire amount. You are having a profit. Now, what is the amount of dividend you are declaring? The amount of dividend proposed to declare 10%. Dividend will be always declared on the equity. So what is the amount of dividend declared? And one more important thing, the average rate of dividend during the last 3 years is 12%. So condition number 1 is what? Condition number 1, rate of dividend should not exceed what? Should not exceed average rate of previous 3 years. Condition satisfied. Previous 3 years average rate is nothing but 12%. Proposed rate of dividend is nothing but 10%. So this condition is satisfied. So first condition satisfied. Condition satisfied. All the conditions you are supposed to satisfy. Then let us see, first of all, before going to the second condition, what is the amount is required? Dividend. What is the dividend we are drawing here? Dividend 10% on 80 lakhs. 10% on 80 lakhs. So you want to pay a dividend of 8 lakhs. You want to pay dividend of 8 lakhs. And one more point I forgot to mention here. Before paying the dividend to equity shareholders, preference shareholders dividend is supposed to pay. You have to pay the preference dividend to the preference shareholders, then only you need to pay the dividend to the equity shareholders. Now you are having a net profit. So current year you are having a profit. What is the profit there? The profit is 3 lakhs. Now what I mentioned of this profit, first I should use this for making payment of my preference dividend. So what is the preference dividend? Let us see. 9% on 17 lakhs 50,000. So 9% on 17 lakhs 50,000 will give you 1,57,500. So I was having a profit of 3 lakhs, but the preference dividend is what? This. After making payment of preference dividend, I am having only 1,40,000. So now what is the shortfall? You are having a profit of 1,40,500, but you need to pay a dividend of 80 lakhs. What is the shortfall there? The shortfall is going to be 6,57,500. So now amount to be withdrawn is this. Amount to be withdrawn is nothing but 6,57,500. Now as per the standard, what it says, maximum amount. What is the maximum amount? Maximum amount cannot be greater than 1/10 of your paid up capital plus reserves. 1/10 of your paid up capital plus reserves, which means what? 1/10 of paid up capital is 80 lakhs plus 17 lakhs 50,000 is nothing but your paid up capital, plus free reserves you are having 25 lakhs. So paid up free reserves is going to be 25 lakhs. So ultimately 1/10 of this is the maximum amount. So the maximum amount which require is what? 1/10 of this is coming to 12 lakhs 25,000. You can draw maximum amount of this, but amount required is what? Amount required is much less than this. So you are drawing only 6,57,500. Now what is the last condition here? The last condition, if we try to see, is nothing but, let us see the last condition. The third condition which we need to see is nothing but find out balance of reserve. Compare that with 15% of your paid up capital. Now what is my balance of reserve? Let us see. The free reserves was initially 25 lakhs. Of this, how much you are using? 6,57,500 you had used. Now this you compare, this should be greater than 15% of your paid up capital. 15%, what is my paid up capital? 80 plus 17.5, that gives you 97 lakhs 50,000. So now 97 lakh 50,000, 15% of that, you are getting what? Let us see, this difference is what? 25 lakhs minus this, you are getting 18 lakhs 45,000, sorry, 42,500, 18 lakhs 40,500. This should be greater than 15% of your paid up capital. 97 lakhs 50,000 into 15% will give you 14 lakhs 62,500. So ultimately, condition satisfied. So now what is the question basically about? He is asking you, from the following, ascertain the amount that could be utilized from the general reserve. So ultimately, you can use the respective amount. All the conditions are satisfied. Since all the conditions are satisfied, you can happily use this 6,57,500. That's it. That's what is the conclusion which you should give. With this, we had finished your managerial remuneration. With this, we had also finished something called as a divisible profit. So in next class, we'll go to the dividend distribution tax, which is a small topic. Then we'll discuss on schedule 2. Then we can work on the problems. With that, company finance statements will be done.